Hello and welcome. My name is Jonathan Lopez, and on behalf of Nicholas Johns, this is the financial analysis of Microsoft versus Oracle for the Financial 139 case number 1. So today we're going to talk about who the major shareholders are for Microsoft and Oracle, why these investors care about cost of capital, what is the cost of debt financing for each company, what's the cost of equity financing for each company, what is the overall cost of capital, could we lower this cost of capital by changing our capital structure? And how would that restructuring affect the way the company works or operates? Would it create any unnecessary risk? Lastly, we're going to see what competitors do in the same industry, and then see if our stock price is fairly valued against the market. First, we're going to discuss some shareholder information, and from the information presented, we see that ownership of the publicly traded firms Microsoft and Oracle are held by large institutional investors. And in fact, the top 10 shareholders of each company make up large portions of their total shares outstanding. Microsoft is 21.8% owned by their top 10 shareholders, while Oracle is 21.4% owned by their top 10 investors. And it's not surprising to see that the percentages of the top 10 shareholders are almost the same for these very large public companies. In fact, it is common for very large companies to be the major shareholders of publicly traded firms. And this is further shown by Vanguard Group Incorporated being the top shareholder of each company, and the top 4 shareholders of both firms being identical. Next, it's important to understand why investors should care about their capital structure of the firms that they're investing in. And investors should care about the capital structure because the capital structure allows a firm to maintain the lowest possible cost of capital. And this can be accomplished by finding the optimal debt ratio. Otherwise, with little or too much debt, the cost of capital might be a little too high. And if done correctly, it will also maximize the return for the shareholders by increasing the value of the firm and thus increasing the value of the stock. The tables provided by Professor DeModron's website show the debt-equity ratio at their current level and their optimal levels. From these tables, we can see that both Microsoft and Oracle are well below their optimal debt-equity ratio. There's also other factors to consider when trying to find the optimal debt ratio. This includes tax rate, the ability to pay interest, variance in operating income, default spreads, and firm projects. Continuing on, we're going to discuss some of the advantages of debt and the disadvantages of debt. Firstly, let's talk about the advantages. One of the biggest advantages of debt is tax savings. By taking on debt and using the interest payments as a tax shield, the company can obtain more capital at a lower rate. Although it ultimately lowers the amount of income, the interest payments are tax deductible, whereas other uses of cash, such as paying dividends, are not. The tax rate of the firm can be a big determining factor on a capital structure developed within the firm. The higher the tax rate, the more debt the firm can take on to reach the optimal debt ratio. This holds true because an increase in the tax rate will make the tax savings much greater or much higher for each dollar of debt spent. So even though the effective tax rates of both companies are similar, with Microsoft paying 23.7% and Oracle paying 23%, their optimal debt equity ratios are not. However, both companies could see increased tax savings by increasing their total amount of debt. Now, some of the disadvantages of debt include higher bankruptcy costs or agency costs. These higher bankruptcy costs can be found by multiplying the probability of bankruptcy by the costs associated with it. And this really includes the volatile cash flows that make up the probability of defaulting much greater. So if you have volatile cash flows, incurring more debt might not be best suited practice for your firm. And talking about agency costs, which is a conflict of claim between the shareholders and bondholders on the capital decisions of the firm, these are seen as stipulations of the bond agreements that bondholders write as covenants to protect themselves against expropriation, which costs the firm in monitoring and the loss of flexibility of their assets. And when talking about the loss of flexibility on assets, it's most likely to occur when firms do not have a safe or consistent investment opportunity. So if you are taking or incurring more risk than you're ready for, it'd be best served to reduce your amount of debt at all costs. Next is the after-tax cost of debt. Now, the after-tax cost of debt for Microsoft and Oracle can be found by multiplying the pre-tax cost of debt that we just found by 1 minus the tax rate. Now, the tax rates for each company were found from their respective income statements provided by Morningstar. Microsoft's effective tax rate was found to be 23.7%, and Oracle's effective tax rate was found to be 23%. Therefore, for Microsoft and Oracle, they have a 0.02 and a 0.025 after-tax cost of debt, respectively. Now that we understand the cost of debt and the pre-tax and after-tax cost of debt financing, what is the cost of equity financing? And now to find this out, you use the capital asset pricing model, also known as CAPM. And the way you use this is the risk-free rate is the current yield on the 10-year Treasury bond at 2%, and the market risk, or the return of market, the historical market return in this case, will be 7.5%. And this was provided to us by Dr. Shiroki. And then after finding the information, we can calculate the market risk premium using the equation return of market minus the risk-free rate. The market risk premium was found to be 5.5%. We can then rearrange the CAPM equation to say risk-free plus beta times the return of market, or the market risk premium. This information was provided to us thanks to Professor DeModderon's tables below, which let us know what the historical risk premiums were for across equity markets in the last 110 years. And then in this case, the last piece of information needed to find the CAPM for Microsoft and Oracle is beta. And the beta for the respective firms was found by regressing both the 5-year monthly and 2-year weekly returns against the market benchmark S&P 500. The factors produced can be found using the equations. And these equations came out to be the CAPM of 7.33% for Microsoft and 8.05% for Oracle. To understand our overall cost of capital, first we assess the market capitalization of each firm, as well as the equity and debt ratios of each firm for Microsoft and Oracle, and then we plug and play them into the WACC equation. This is also known as the weighted average cost of capital equation, and its calculations are as follows. In this instance, we have Microsoft coming in with a 6.08% weighted average cost of capital, and Oracle with a 7.23% weighted average cost of capital. After assessing our overall cost of capital, what we'd like to do is know whether or not we can lower our cost of capital by changing our capital structure. This could be by incurring more debt, or incurring more equity by producing more goods, or decreasing our amount of debt or loans we take out, and selling off inventories or raising capital and other facets. But the main question, can you restructure to lower your cost of capital? And the answer is yes, you can. But there are some implications regarding that, that being that bond ratings can increase or decrease for the firm, which could increase your interest rate on your debt, making you have more interest payments or a heftier interest payment to pay than you normally would. Now that we've assessed our overall cost of capital, what we'd like to know is, would more debt create unnecessary risk? And as previously mentioned, more debt does inherently have an increased amount of risk, and the question is whether or not that risk is necessary for the firm at hand. So what we're trying to do is reach an optimal level of debt for the company so that they can maximize their amount of profit, right? So Microsoft moving from a AAA rating to an A- rating, or Oracle moving from an A+ rating to an A- rating, there's going to be more debt over to these companies, these firms, and it will create unnecessary risk. The companies would have increased cost of debt caused by lower bond ratings and a higher chance to default on obligations. It's also beneficial for Microsoft and Oracle to stay below their optimal levels of debt so that they have greater flexibility in choosing potential projects that might have a higher rate of return than current endeavors. The capital structure analysis presented in our paper has shown us that a level of debt that a firm has is a major factor in determining firm value. Both of the firms, Microsoft and Oracle, could potentially benefit from higher levels of debt. However, there are consequences for incurring a higher level of debt that were discussed earlier. Based on the analysis, Microsoft could go up to 30% debt, their optimal level, to reach a firm value of $288 billion. Oracle itself could increase to about 40% debt, their optimal level, to reach a firm value of $218 billion, respectively. The figures above show and compare Microsoft and Oracle with industry peers. The figure compares current assets and liabilities against total assets and stockholder equity. In this case, Microsoft has almost twice as much debt as Oracle, and when comparing Microsoft to a competitor like Apple, you'll see that the total amount of debt is comparable. However, Apple's level of equity is much higher and their market capitalization much greater. Furthermore, we see Google, the front runner in the industry currently, against its competitors, happily totes a 76% stockholder equity against total liability and equity. Valuation of the company's share price was done using 3 different methods. The share prices that we will be comparing these valuations to are taken from the December 31st, 2012 adjusted close prices for Microsoft and Oracle. The share price for Microsoft at the time was $26.71. The share price for Oracle at the time was $33.32. The first is a relative valuation that gives a measure of the current share price by multiplying a forecasted estimate of EPS, in this case forecasted out 2 years, and a long-term average PE. The two are multiplied together to get the forecasted share price in 2 years, and then that future price is discounted back at the cost of equity. The second stock price valuation we use is the free cash flow approach. The model discounts all cash flows that are available to investors, or the free cash flows, at the WACC. The continuing value is then added to the enterprise value to find the total value of the firm in the future. The continuing value is defined as the present value of cash flows that will occur after the forecasted period. In this analysis, we have used 2 methods, the free cash flow or FCF approach and the EBI-TDA approach to find the continuing value. The forecasted period was 10 years, the risk-free rate was 2%, the market risk premium was 5.5%, and the information for the respective companies such as tax rates, cost of debt, cost of equity, levered beta, WACC, etc. were taken from analysis that we spoke about earlier. So for the free cash flow approach to CV, or continuing value, we see that Microsoft's intrinsic share price is at $18.82. Oracle's intrinsic price is at $24.23. Using the EBI-TDA approach, we see that we get a value of $26.39, and Oracle has a value of $36.92. From the values produced in the analysis, we can see both Microsoft and Oracle are overvalued in terms of their current stock price. The EBI-TDA multiple approach to calculating continuing value produced much higher share value than the free cash flow approach. This is caused by the large amount of earnings before interest tax as percentage of sales. Both of these companies turn a large amount of sales and have low operating margins that increase their amount of earnings. The free cash flow approach relies on the amount of FCF that the firm can generate. The low free cash flows as a percentage of sales means that Microsoft and Oracle have to spend a lot of money on continuing to market their business and create new technology. In this case, the FCF approach is a better indicator of the value of the firms. Investors are worried about the health of a firm, and free cash flows are a better indicator of how the firm earns and spends its money than the EBI-TDA multiple. In conclusion, we'd like to know who our shareholders are. We'd like to know and care about the cost of capital. As an investor, it's always important to know the cost of debt financing and the cost of equity financing for a firm, as well as trying to achieve those optimal levels in capital structure. Also, it's never, too necessary to take any risk that doesn't benefit the firm. That's why we always run forecasts and analysis to see what certain levels of debt and risk are being incurred to any firm, and really what the output is of those decisions being made by management. And then lastly, we'd like to say that our stock price is not very fairly valued. It's selling currently at a premium, so if you're a holder, I would continue to hold until you see any sort of major correction or trying to find a good place to make profits. Thank you very much.